Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through the market weakness. Today, we are putting on the hard hats, we're grabbing the blueprints because we are conducting a full-scale structural analysis of a biotech titan, Vertex Pharmaceuticals. Their Q4 2025 earnings report just hit the street, and frankly, the market is spinning, trying to figure out what it all means. But you know what? This isn't just about a single quarter. This is about the very integrity of a multi-billion-dollar structure. So let's get to work. That's exactly right. Because when I look at this report, what I see is a beautiful, gleaming facade, but I also hear some creaking in the floorboards, you know? On the surface, things look pretty strong, but there are numbers in here that just make you stop and ask that one big question. Is Vertex building a fortress that's designed to withstand any storm, a true skyscraper of profitability? Or are we looking at the very beginning of a house of cards? Something that's beautiful to look at, sure, but maybe one stiff breeze away from a total collapse. That is the core of our inspection today. And to answer that question, we are going to be methodical. This is our inspection checklist for the day. First, we're going to examine the headline numbers in a section we're calling the headline, a noticeable crack. Second, we're going straight to the bedrock of the company, what we call the foundation, the CF fortress. It's everything. Third, we'll look at their expansion plans, the new wings commercial diversification. Then fourth, we'll analyze the blueprints, the 2026 plan. You have to see where they're going. Fifth, every structure, and I mean every structure, needs a stress test, so we are going to examine all the risks. And finally, we will deliver the iron financial verdict. Let's get started. Okay, let's dive right into this. Part 1, the headline. Whenever an earnings report comes out, the first thing everyone on Wall Street looks at are the two big numbers, revenue and earnings per share. Think of it like the curb appeal of the entire structure. It's what tells you whether you should even bother walking up and opening the front door. And for Vertex, well, the view from the street? It's complicated. Complicated is absolutely the right word, because right out of the gate, you see a major contradiction. You've got this strong, gleaming facade with that big revenue number, but then your eye is immediately drawn to this fine but very noticeable crack running down the wall. That's the earnings per share. And that right there, that's the tension we have to unpack today. Is this just a cosmetic issue, a bit of cracked plaster we can patch over, or does it go deeper, signaling a real fundamental problem with the building's core profitability? That's what we're here to find out. So let's start with the good news, the strong part of the facade. Just look at this number, $3.19 billion in revenue for the fourth quarter alone. I mean, in a tough market, that's a solid 10% increase year over year. It also managed to edge out analyst forecasts, even if it was just by a hair, 0.31%. That tells you their products are still in high demand, and the cash register is ringing and ringing loudly. This is what we call heavy lifting in the current economy. On its own, this number looks like a sign of a very healthy, very robust operation. But you see, the cash register doesn't tell the whole story, does it? You have to look at what's left over after you pay all the bills. And this is where that crack appears. $5.03 in earnings per share. That missed the forecast. Now, I know what you're thinking. A miss of less than 1%, that might seem like a rounding error to you and me, but let me tell you, in this league, misses matter a lot. The high-frequency trading algorithms, the institutional investors, they see a miss no matter how small, and it raises immediate red flags. It forces the question, why? Is this an early sign that costs are getting out of control? Is there incredible gross margin, which is nearly 86%? Is it finally coming under pressure? It means that for every single dollar that came in the door, less of it made it to the bottom line than the street expected. And that is a potential sign of inefficiency we need to keep a very close eye on.
Right. And to really understand that miss, you can't just stay on the surface. Any good structural inspection starts at the bottom. You have to get into the basement and check the foundation. For Vertex, that foundation, the massive concrete slab that everything else is built on top of, is its cystic fibrosis or CF franchise. This isn't just a part of their business. For years, it has literally been their entire business. And they're not shy about it. They're not trying to hide it. This is a direct quote from the CFO, Charlie Wagner, right on the earnings call. He's telling you, clear as day, this is our bedrock. The CF drugs are the cash-generating engine that funds absolutely everything else. The R&D for new drugs, the big marketing campaigns for new launches, not to mention that massive $12.3 billion cash pile sitting on their balance sheet. So the health of this foundation isn't just important, it's non-negotiable. If this part of the business starts to falter, the entire structure is at risk. And this slide, well, it paints a really stark picture of just how critical that foundation truly is.
Based on the 2025 revenue numbers, the cystic fibrosis franchise isn't just the biggest slice of the pie, it's practically the entire thing. The new products we're hearing about, CASGEVY and JOURNAVX, they're just tiny, almost invisible slivers right now. This is a perfect visual representation of concentration risk. All the weight, all the pressure is resting on this one single foundation. So let's take a closer look at the concrete itself.
And here it is. This is the number that gives the bears all their ammunition. This is the first really visible stress fracture in that foundation. Trikafta, their flagship multi-billion-dollar blockbuster drug, saw sales decline by 5.5% year over year. Now look, $2.57 billion is still a massive, massive number. But a negative sign next to your core product, that is a major red flag. So the crucial point we have to ask is this just a blip, or is this the beginning of market saturation? Have they finally reached most of the addressable patients for this drug? If the answer is yes, then this foundational pillar is starting to erode, and that is a very serious problem.
That is the bear case, absolutely. But Vertex would argue they saw this coming from a mile away and have been proactively reinforcing that foundation with their next-generation therapy, ALYFTREK. This is what they'd call their new support beam. And while Trikafta might be showing signs of age, ALYFTREK is showing absolutely explosive growth. Sales were $380 million in Q4. That's up from $247 million in Q3. That's a staggering 54% sequential growth. They're positioning this as the new beam, designed specifically to take the load as Trikafta matures. What they're doing is essentially upgrading the foundation while the building is still standing on it, which is an incredibly complex but absolutely necessary maneuver.
Okay, so the foundation is showing some wear and tear, but it's also being actively reinforced. That's clear. So now let's move up from the basement and look at the new construction. For years, the biggest knock against Vertex, the thing every analyst talks about, has been its over-reliance on CF. So the real test of its long-term durability is whether it can actually build new, revenue-generating wings and successfully diversify away from that core foundation. And this is the company's official story, coming straight from the top, the CEO, Reshma Kewalramani. She's basically saying, we hear you, we know we need to diversify, and guess what? We are doing it. But let's be honest, talk is cheap in this business. Every CEO talks about diversification and pipeline advancement. Our job here at Iron Financial is to inspect the actual work. Is this just a fresh coat of paint to make things look good for Wall Street? Or are they actually building new, load-bearing structures? Let's go check the receipts.
And you know what? The receipts are looking pretty solid. This chart right here is the proof. It shows the hard numbers behind the CEO's words. Just look at the quarter-over-quarter growth in their two big new launches. CASGEVY, their revolutionary gene therapy for sickle cell disease, more than tripled its revenue from Q3 to Q4. It jumps from about $17 million to over $54 million. That's a heck of a ramp. And JOURNAVX, their new non-opioid pain drug, also showed a very healthy jump, from under $20 million to nearly $27 million. This isn't theoretical growth we're talking about. This is real, tangible momentum. These are the very first bricks being laid for those brand new wings. The momentum is definitely there, I will grant you that. But let's keep it all in perspective for a second. Look at these full-year numbers. CASGEVY did $116 million for the entire year. JOURNAVX did $60 million. Combined, that's less than $200 million for a company that just did about $12 billion in total revenue. Yes, they wrote over 500,000 scripts for JOURNAVX, and yes, securing coverage with all 3 national PBMs is a crucial, crucial win. And their goal to triple prescriptions is ambitious, I'll give them that. But these are still very, very small numbers in the grand scheme of things. So are these new wings, or are they just window boxes right now? It's promising, but they have a very long way to go before these can carry any significant weight for a company of this size.
That's a completely fair point. The current structure, as it stands today, relies almost entirely on that CF foundation. So, after inspecting what's been built, it's time to unroll the blueprints and see what they plan to build next. This is where we look at the 2026 guidance and we dig deep into the R&D pipeline to see if those window boxes have the potential to become full-fledged extensions to the building.
And here are those blueprints, right here in black and white. The headline is another solid year of 8 to 9% growth, pushing total revenue towards that $13 billion mark. But that is not the most important number on this page. The one I want everyone watching to focus on is the third line down, non-CF product revenue. They are explicitly guiding to $500 million or greater. This is management drawing a line in the sand. They are telling the market, loud and clear, that they expect to more than double the revenue from these new products in a single year. This is the metric we're going to hold them to. This is the benchmark for diversification success in 2026.
Okay, $500 million is a start. but it's not going to replace a multi-billion-dollar drug that's starting to slow down. Which brings us to the next, much bigger potential wing of this fortress, their emerging renal franchise. If you listen to the Q&A on the earnings call, the analysts were laser-focused on this. They're developing a suite of drugs for serious kidney diseases, with a drug called povetacicept for IgA nephropathy leading the charge. Now, the company's even saying that this franchise could ultimately rival the scale of our CF business. That is a massive, massive statement. The question for us is this just another blueprint, a grand architectural drawing of a beautiful future that might never get built? Or is this a concrete plan for their next multi-billion-dollar engine?
This slide shows us the construction schedule, and it proves these aren't just vague promises. These are concrete, near-term milestones for 2026. The big one, the one that could be an absolute game changer, is right there at the top. Completing the regulatory submission for povetacicept in the first half of this year for a potential accelerated approval. That's not some distant dream, that's imminent. At the same time, they're not neglecting their core. They're advancing an mRNA therapy for the remaining CF patients, while also expanding their pain franchise and moving CASGEVY into younger patient populations. Each of these steps is critical, but that povetacicept filing is the one that starts laying the real foundation for that massive new renal wing, and it is happening now.
Okay, I'll admit the blueprints look impressive. The construction schedule is aggressive. But any responsible inspector has to perform a stress test. You have to actively look for the known weaknesses, the potential points of failure that could bring the whole thing crashing down. It's time to see how this structure holds up when we really put some pressure on it.
Let's break these down using our construction metaphor one by one. First, the foundation itself. We already saw the stress fracture with that Trikafta number. CF market saturation is a real and a very present danger. Second, there's execution risk. Think of this as the craftsmanship of the builders. Launching one new drug is hard. Launching multiple complex therapies like CASGEVY and JOURNAVX at the exact same time is like trying to build two different wings of a skyscraper at once. A single slip-up, a botched marketing campaign, a supply chain issue, it could be incredibly costly. Third, regulatory hurdles. These are the permit delays that can halt construction indefinitely. The FDA is not a rubber stamp. Fourth, you've got competition. There's always another crew building a bigger, shinier skyscraper right next door. And finally, the macro environment. A recession is like an earthquake. It can shake even the strongest foundations by hitting healthcare spending and reimbursement rates. All of these are real, tangible pressures on Vertex's structure.
All right, the inspection is complete. We have examined the headline cracks, we have tested the CF foundation, we've inspected the new wings, reviewed the blueprints, and we have run the stress test. It is now time to step back, look at the entire structure, and deliver the final Iron Financial inspection report.
The bull case is pretty clear. This thing is a solid fortress. They are sitting on a $12.3 billion cash war chest. That gives them immense flexibility to acquire new tech, invest in their pipeline, and weather pretty much any storm. The CF Foundation, while it's maturing, is still a massive cash cow that generates billions and billions of dollars. And the diversification, it isn't just talk anymore. The momentum in the new launches is real, and the pipeline, especially that renal franchise led by povetacicept, provides a very clear blueprint for future growth. It's a compelling picture, but it is, in the bear case, the whole house of cards argument is just as compelling. That EPS miss, however small you think it is, it hints at rising costs and pressure on profitability. That 5.5% decline in Trikafta is the clearest signal yet that the CF Foundation has hit its growth ceiling. The execution risk of juggling all these new, complex launches is sky high, and a single stumble could be disastrous. And let's be totally honest, all that future growth from the renal pipeline is still just on paper. It's a blueprint, not a building. It is not yet guaranteed.
So, there you have it, the full inspection report. On one hand, you have a financial fortress with a massive war chest and a clear, ambitious plan for expansion. On the other hand, you have a structure that is showing its first real signs of stress, with a maturing foundation and a future that relies on flawless execution of some very complex new plans. The final decision, as always, rests with you. We've laid out the evidence, we've shown you the strong points, and we've shown you the weak points. So now, you have to ask yourself, after this inspection, will you be laying a foundation with Vertex in your portfolio? Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.